Welcome back, everybody, to Volatility Trading Strategies. So this is the 125th video that I've made on this channel since I started. Now there's going to be hundreds more, of course. I've got a massive list of topics still to get to, and every time I scratch one off the list, I think of two more to add to it. So make sure you're subscribed, and also click that little bell icon so you're notified of all the new videos when they're released. Now it is pretty time-consuming to make all of these, and I'd like to think at least that all the videos I've made are teaching an important subject. But naturally, some of the topics are more important than others. And today's video is just something that I think everybody who has an interest in volatility ETPs just needs to watch to the end. Because it's a very common misconception that volatility ETPs derive their price based on some kind of buy high, sell low dynamic in the rebalancing process, based on the shape of the VIX futures term structure. So today I'm going to dispel that myth and explain why, despite popular opinion, the rebalancing of those VIX futures actually has nothing to do with the price of volatility ETPs. And you know what to do already. Destroy that like button so the YouTube algorithm goes crazy with excitement. And let's get into this very important subject. So first, I do want to explain what this common myth is, because truth be told, it does actually make a lot of sense, and I can completely understand why so many people mistakenly think this is how they work. But I do really want to stress here, this is not how they work. I am just expressing what the common belief is, so we can set a baseline for comparison. People's attention span watching YouTube videos can be a little inconsistent, and I don't want people out there just watching the first 2 minutes and then getting the wrong explanation. This is the VIX futures term structure as it was on January 2nd, 2020. Now the reason I'm choosing this date is because I'm starting with a term structure in what we call contango. That's essentially when the VIX futures are upward sloping to the right. So all of those dots represent a monthly VIX future. We've got January, February, March, all the way through November. Now with respect to volatility ETPs, VXX, UVXY, SVXY, all of those, they only hold a composition of the front 2-month futures. So just these two, M1 and M2, are the only ones that matter. On this date, January 2nd, 2020, notice how the price of M2 is higher than M1. This is called contango, when that gap of M2 over M1 is positive. Now there's two pieces of information here that lead people to the wrong conclusion about how these volatility ETPs actually work. The first is how often the VIX futures term structure is in contango, and the second is just how poor that long-term performance of the VXX actually is. So first, this is a chart showing the relationship between the front 2-month M1 and M2 VIX futures since the VIX futures launched on March 26, 2004. As you can see, 83% of the time it's a positive number, and only 17% of the time it's a negative number. This means 83% of the time the VIX futures term structure is in contango, and only 17% of the time they are in what's called backwardation. And the second, this is the infamous VXX, a long volatility ETP that has suffered tremendous losses since it launched on January 30th, 2009. This is why the short volatility trade is so popular these days. You can see the VXX has gone from a split-adjusted price of over $107,000 in 2009 to just $25 today. This thing is down 99.97% since inception. Now remember, the VXX only holds a combination of M1 and M2 VIX futures, nothing else. And the way it works is, it starts the beginning of the new VIX futures expiration cycle with a 100% weighting on the M1 VIX future, and a 0% weighting on the M2 VIX future. Then as the days go by, it sells a little bit of the M1 VIX futures, and it uses that capital to buy a little bit of the M2 VIX futures. And at the end of the monthly cycle, right before expiration, it will be holding 100% of the back month M2 futures, and 0% of the front month M1 futures. Then the M1 VIX future expires, and the cycle resets with a 100% allocation to the new M1 VIX future. So again, I have to stress here that what I'm about to say is not true. This next part is just what people believe is happening. This is the common myth that I'm trying to dispel. The common thinking is, because the VIX futures term structure is in contango 83% of the time, meaning most of the time this M2 future is more expensive than the M1 future, they think that the VXX is selling the cheaper M1 VIX future and using that capital to roll into the more expensive M2 VIX future. That this somehow creates a cycle of VXX selling low and then buying high, selling this cheap one and then buying this expensive one. And then as the theory goes, well, what happens if you continuously buy something expensive and then sell it for cheap over and over again? Well, you lose money, right? That's the common explanation you'll hear for why that VXX is down over 99% since inception. And it must be true, right? The VIX futures term structure is in contango 83% of the time, and every time the VXX does that daily rebalancing, it seems to be losing money. That does make some semblance of sense, which is why I said in the beginning, I can kind of understand why this misconception is so commonly held. But it's not actually true. The daily rebalancing of these volatility ETPs doesn't cause the ETP to lose any value at all. That daily rebalancing is done at a net zero change to the NAV of VXX and UVXY. I can show you this with a very simple example. Let's imagine an investor had a simple two-stock portfolio. 75% of their portfolio is Apple and 25% is Tesla. Now, pretty unrealistic, I know, but hey, that portfolio would actually have done pretty well the last few years. So what happens to the value of this person's portfolio if they want to rebalance and go from the current 75-25 allocation to a 50-50 allocation? Remember, Apple and Tesla are priced differently, just like the VIX futures are priced differently. And at the time of this recording, Apple was 112 and Tesla was trading at over 372. So the investor sells 25% of their Apple stock and uses that capital to buy Tesla stock. In this case, they sell 223 shares of Apple and use the proceeds to buy 67 shares of Tesla. After the rebalance, they now have 50% of their money in Apple and 50% in Tesla. So what's the net change in value of this portfolio after the rebalancing? Well, zero, of course. Nothing happened. The investor is just moving capital from one stock to another. The net liquidation value of their portfolio hasn't changed one penny. The allocation size and the number of shares of each stock has changed, that's true, but the overall value is identical. The only thing that changes the value of that investor's portfolio is the forward changes of the stock price of Apple or Tesla. If over the next day, week, or month, the prices of those stocks actually change, then that will affect the value of that portfolio. Well, the VXX is exactly the same thing. Remember I said, at the beginning of the new monthly cycle, VXX is holding 100% of the front month M1 contract and 0% of the back month M2 contract. Assuming the same $100,000 portfolio, just for simplicity, when the daily rebalance happens and VXX sells some of its M1 to use that capital to buy M2, no change of value occurs. It's true the M2 is priced higher than M1, but that makes no difference at all. It's simply selling some of the shares of M1 to buy some shares of M2. The net liquidation value, or in this case the NAV of VXX, hasn't changed one penny due to this rolling of contracts. The only thing that changes the value of VXX would be an actual change in the price of those M1 and M2 VIX futures over time. If they stay the same from one day to the next, the daily rebalancing of VXX does absolutely nothing to the price of the ETF. If they stay the same from one day to the next, then the VXX price would be the same from one day to the next. It's not the rebalancing, it's not contango or backwardation, it's not buy high, sell low, it's none of those things. I know this is probably what you've heard at some point, but that's just an incorrect explanation that's been shared around over the years and people just repeat it now. But remember, the only thing that changes the value of VXX or UVXY is the actual changing values of those VIX futures over time. If those prices change, then of course the volatility ETPs will change value as well. In a previous video called VXX is Not Broken, I'll leave a link here so you can quickly reference it, but in that video I explained the true mechanism by breaking down what's called VX30. VX30 is a 30-day constant maturity VIX future contract that takes into account both M1 and M2 with respect to how many days to expiration it has in the current cycle. The changing value of that VX30, that's what's changing the value of the volatility ETPs. If VX30 goes up, then the VXX will go up. If VX30 drops down, then the VXX will go down. It doesn't matter if the VIX futures are in contango or backwardation, and it doesn't matter if the rebalancing means that it's buying more or less expensive VIX futures. It's only the changing value of that VX30 that determines the price of the VXX. Now, of course, contango and backwardation, if those conditions persist, then that does have an influence over time, but on a day-to-day basis, that's not at all what's happening. In that last VXX is Not Broken video, I showed that in the last few weeks, the VIX futures have been in very steep contango. Yet still, the VXX went up at the same time as the S&P 500. In fact, it went up a lot more than the S&P 500. For anyone who believes in the incorrect myth of VXX rebalancing and buying high and selling low during contango, they would have been very confused by that period. It would seem impossible, and they might even complain that the VXX is manipulated, or it's a scam product that is broken. But remember, the daily rebalancing is done at a net zero change to the value of the ETPs. Just like the rebalancing of our friends Apple and Tesla portfolio is also done at a net zero change to the net liquidation value of that portfolio. The share count changes, the allocation amount changes, but that value does not. So even if the VIX futures are in very steep contango and that M1 price is way above the M2, the VXX can still go up, and it sometimes does. It's very important to remember that although the volatility ETPs do function on a very strict methodology, the VIX futures market itself is a freely traded market. And if those VIX futures are bid up by traders, maybe due to election fears or whatever it is, then it does not matter what the shape of the VIX futures are in. Even strong contango, the VXX can still go up. The VX30 does move at a slightly different beta factor than the VXX, it's not 1-to-1, but this is the true mechanism of the volatility ETPs, and in my opinion, anybody trading them needs to understand this. It's not nearly enough information to be trading volatility ETPs and just looking at the shape of the VIX futures term structure. The old short vol when in contango and long vol when in backwardation, that will lead to insanely large drawdowns. That simple metric may be a good guideline to get somebody started on their path, but the volatility market is way more complex than that. I personally track a long list of volatility metrics, and I'm constantly cross-referencing them all to determine my trades. Obviously, everyone is going to have their own style and their own metrics, but at the very least, traders need to understand what's true and what's not about how these complicated products work. In this case, the buy high, sell low because the VIX futures are typically in contango has nothing to do with anything. That's simply not how it works. Remember, the daily rebalancing is done at a net zero change to the NAV. To succeed at trading volatility ETPs, I do suggest people focus on what actually causes its price movements. Isolate that, and you should make more money over time. And if you want a little guidance in what metrics may be more useful than others, feel free to claim your free trial on my website, check out our VTS Volatility Dashboard, as well as all of our live trades. You're always welcome to join us. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.